A recent CNN article claims that Iran is considering allowing a limited number of oil tankers to pass through the Strait of Hormuz, provided the oil is traded in Chinese yuan. If true, this would be a direct challenge to the petrodollar system. To understand why, we need to look at how the petrodollar system works and why the Middle East is at the center of it. Before the petrodollar, the US currency was backed by gold. The US controlled most of the world's gold reserves, and with Europe rebuilding after World War II, the US emerged as the dominant economic power. This led to the Bretton Woods Conference, where 44 countries agreed that the US dollar would serve as the global reserve currency, backed by gold. However, by the late 1960s, the system began to break due to massive spending in Vietnam War and social programs. To fund this, the US printed more dollars, resulting in an oversupply relative to gold reserves. As a result, confidence in the system declined and countries started to convert the dollars to gold. In response, President Richard Nixon implemented the Nixon shock in 1971, ending the dollar's convertibility into gold. This marked the transition to a fiat currency system where money is backed by trust rather than physical assets. The dollar needed a new foundation. That foundation came from oil. Following the Yom Kippur War and the Arab oil embargo, oil became the most strategically important commodity in the global economy. In 1974, the United States reached an agreement with Saudi Arabia and other oil-producing countries that oil would be priced and traded exclusively in US dollars. In return, the US would provide military protection and security guarantees. This created the petrodollar system, effectively tying oil to the US dollar. So here's how it works. Let's say a country like Japan wants to buy oil. They can't just pay in yen, they need US dollars. They have to either export goods to earn USD or exchange its currency for USD, then use those dollars to purchase oil. Oil exporting countries receive these dollars and reinvest them into US Treasury bonds, US banks, and US financial markets. This creates a loop. The world demands dollars to buy oil, and those dollars flow back into the US financial markets. This is known as petrodollar recycling. This system provides the United States with several advantages: sustained global demand for its currency, lower borrowing costs due to constant demand for US debt, the ability to run persistent fiscal deficits without immediate crisis, geopolitical leverage through the control of the global financial system. Iran's significance is not just political, it is geographical. It sits next to one of the most important locations on Earth, the Strait of Hormuz. Around 20% of the world's oil supply passes through this strait, including exports from Saudi, Kuwait, UAE, Qatar, Bahrain, and Iran. Anything that happens in this region will have massive global impact on oil. And that is what we are experiencing right now with the strait closed by Iran, that is driving the oil prices up and causing shortages worldwide. This directly affects the petrodollar, which depends on stable, predictable oil flows. Because if oil becomes unstable, countries start looking for alternatives, and war accelerates that process. A conflict involving Iran affects the system in multiple phases. At the start of the war, oil prices spike due to supply fears. Investors move money into safer assets like the US dollar and the US Treasury, causing the dollar to strengthen. As of March 2026, the war has driven the dollar up to 100.54, its strongest rally since late 2024, while crude oil has climbed over $110 per barrel. But as the war continues, oil prices will stay expensive, while global economy begins to slip into stagflation, a mix of slowing growth and rising inflation. High oil prices act like a global tax, increasing the cost of transport, food production, and industrial goods. This puts pressure on both businesses and consumers worldwide. Central banks are then forced into a difficult position. They can either raise interest rates to control inflation risks, slowing growth even further, or hold the rate steady, which allows inflation to persist. On Wednesday, March 18th, the Federal Reserve, ECB, and the Bank of England all opted to hold rates steady. They are stuck in a no-win situation where they can't cut rates because inflation is rising, but they can't increase rates because growth is stalling. This pressure pushes countries to actively reduce reliance on the Middle East and the US dollar through several ways. Firstly, oil trade becomes more diversified. Countries start settling transactions in alternative currencies such as the Chinese yuan, the euro, or through direct bilateral agreements. This shift has already been gaining momentum, with more oil deals being conducted outside the dollar system. Secondly, countries begin building alternative financial infrastructure. Systems outside US control, such as independent payment networks, multi-central bank platforms like Project Enbridge, allows for direct settlement without relying on US-controlled systems like SWIFT. Thirdly, nations focus on strategic de-risking. Many countries, particularly those in BRICS, reduce their reliance on the dollar by shifting reserves into gold or other currencies, creating a parallel financial system that operates independently of Western influence. Iran is currently playing a pivotal role in this transition. Due to long-standing sanctions, it has already sold oil in non-dollar currencies and built trade relationships outside the Western system. The war with Iran will accelerate this process significantly. If oil shipments through the Strait of Hormuz are selectively allowed only for transactions conducted in yuan, it creates a parallel oil market outside the dollar system, one that other countries may follow. The petrodollar is not just financial, it is also military. It relies on the perception that US can guarantee stability in key oil regions. If that guarantee is questioned, countries like Saudi Arabia may reconsider exclusive dollar pricing. Even small changes here would have significant consequences. If the petrodollar weakens, the impact on US is massive. There will be less demand for the dollar. If oil isn't fully traded in USD anymore, countries don't need as many dollars. This reduces global demand. Less demand for US debt. If oil exporters like Saudi earn fewer dollars, they invest less into US bonds, and the US relies on foreign buyers to fund its debt. Interest rates rise. If demand for US bonds drops, the US must offer higher interest rates. This affects everything: mortgages, corporate borrowing, government spending. Inflation gets worse. A weaker dollar means imports cost more and prices rise. And the US loses its ability to export inflation to the rest of the world. That said, the petrodollar system isn't collapsing overnight, but it is fading gradually. The dollar's share of global reserves has declined from 70% in the early 2000s to 58% in 2026. At the same time, the majority of the global oil trade, estimated at around 70 to 80%, is still conducted in US dollars. A war in Iran won't instantly destroy the dollar, but it highlights the risks of dollar dependence and tests the military security deal that is foundational to the petrodollar system. This would fuel the move away from a dollar-dominated world into a multipolar system where other currencies like the yuan gain influence. Even a gradual move away from the dollar can reduce US economic power, increase global uncertainty, and change global alliances.